Welcome back to the Retire with Confidence podcast. I'm excited today to be joined by Tyler Arnold of the Arnold Insurance Group. Welcome, Tyler.
Thanks, Dave. Thank you for having me. Excited to be
Oh,
here.
yeah, I'm excited because, as you know, we talk with a lot of retirees, and this is a podcast for retirees so they can retire with confidence. Oftentimes, though, we have to talk about protecting what they've already built up or just protecting their own liability, their own assets. So I wanted to bring you on just to talk through what that looks like. What should people be looking out for? So this will be really helpful for them.
Yeah, let's do it.
So first, before we dive into all that, let's talk about you. How'd you get into the business? I mean, I've known you for a while now, and I know that you really, really grew up in the business. I joke that you got into the business when you were in diapers, and that's probably not too far off. But
Pretty
tell
close.
everybody a little bit about your background and how you got into the insurance business.
Yeah, so I got into it in 2013, actually just right out of high school, and worked in the insurance business all through college. My father was in it. I've got brothers that are in it. I've got cousins and uncles. They're all in it. So it's kind of just in the blood. And like I said, so I've been here. I just celebrated my 11th work anniversary.
Mm-hmm.
So it's been a roller coaster, but markets change and insurance coverage changes. So we've seen it all.
Yeah. So you saw a lot even before you got into the industry because it was just always around the house. So you've really
Oh
got
yeah,
you said 11-year anniversary, but you have a long history of
correct. Yeah,
understanding the dynamics and what's going on.
yeah. Well, like I said, my father's been in it forever. He just celebrated his 39th year.
Hmm.
So, and then, like I said, I got my brothers in. They're on the claims side, regional management side. So
Yeah.
I hear all different aspects of it.
Yeah. And even with your history and of course with your fathers and your uncles and all that, you can talk to them about what's going on and they can tell you how crazy it is right now because it's just bananas with insurance companies
Oh yeah.
pulling out of state and rates going up so much. It's a wild time that even they've never seen before.
Oh yeah. As I'm sure all the consumers that are listening to this are aware, we've seen the influx of inflation over the past 3 to 4 years. And, we've seen that before on the insurance side, but nothing to this magnitude. It's been
Mm.
one of the largest ones that they have ever seen. And not just on the agent side, but even on the company and corporate side,
Mm.
they've had to battle new grounds or come to new battlegrounds and that they've never seen before and make
Sure.
adjustments for it.
Yeah.
So, like you
Awesome.
said, that there's companies that have completely pulled out of states. They've really locked down their underwriting guidelines.
Mm.
If you have past claims experience, they could not even they might even decline you coverage if you're
Mm.
shopping around. So
Wow.
it's been a big change within the past 3 years.
Sure. Sure. So as people are seeing all these changes and reviewing their policies and trying to figure out what's what, let's talk about things that they should be on the lookout for. Because I know that when you and I have discussions, when we work with clients, we're talking about, you know, what I see stuff come up is, people have auto, just state minimum auto coverage and,
Right.
no umbrella policies. So just a lot of areas of risk that just don't need to be there. So what do
Right.
you see when you're reviewing policies or talking with people in terms of, hey, these are the big holes that people need to be filling. It might cost a little more, but you need the coverage because those are the things that are really going to bring you down. So what do you see when you look at that?
Yeah. So like on the auto side, when you look at your auto liability limits, right? So those numbers are there to pay out in the event of an auto liability accident. So those are designed to protect the other people that you hit, and then there's
Mm-hmm.
also the side that protects you or anybody in your car.
Mm-hmm.
So you want to make sure those liability numbers either meet or exceed your total assets at risk.
Okay.
So in the event of an accident, and it's a severe enough one, which is, it can happen, right? I mean, you're planning for something that hopefully never happens, but you need to plan for it. If that severe accident does occur and that other party survives, or if if it's severe enough, they're going to look at two things. They're going to either look at how much they can get from the insurance company in the event of a payout on the liability side, or how much they can get from the person that hit them. All right. So, and they're going to go after whatever's more. So even though you have 100,000 in liability coverage to protect other people, that doesn't mean that's where that claim's going to stop. You can still be sued for 500 million, million and a half,
Mm-hmm.
whatever your net worth is.
Yep.
And the court, if it's severe enough, the court could eventually make you rule in favor to liquidate assets to cover that claim. They can garnish wages. So you really need to have enough liability coverage. That's the number one side of things.
Yeah.
On the auto and the home, I know we've talked about this before. If you get in a car accident, we know how much a new car is going to cost to replace it, right?
Yep.
We got a rough number. If you have a house fire or a house claim, we know how much it's going to cost to repair or rebuild. But if you have a liability lawsuit against you, just because you have 100, 300, 500,000 in coverage, that doesn't mean that's where that claim stops. You can be sued for well over that. So, and you just don't want that hanging over your head. And just to increase that liability coverage, it's $20, $30 a year on a home, from going to 300 to 500,000.
Really?
To go from 500,000 to $1 million, you're probably looking at another $20, $30
per year.
Different per year. Yes.
Oh, wow. Okay.
A little bit different on the auto side. That's you have a higher risk there. But yeah, that's the number one thing, is this, just making sure you have adequate liability coverage.
Sure. So when we talk about state minimum coverage, that's just there to make sure that people have coverage. And it's also important, I guess, to think about if somebody hits you, they might not be, they might not be covered at all, or they might not have adequate coverage. So how can you protect yourself in the case where somebody else is actually at fault? How do we make sure we have our coverage there?
Yeah. So the state minimum requirements are 25,000, 50,000 bodily injury. So 25,000 is per person, 50,000 max per accident. And then another 25,000 on property damage. That's the maximum that the state requires. And then again, they also require uninsured motorist coverage for 25,000, 50,000 on bodily injury. So that protects you or anybody in your car. Okay. And that's the minimum they can carry. But what they don't have to carry is underinsured motorist.
Right.
So for example, if I have state minimums, 25, 50, 25, and I hit you, and your claim or your injuries exceed that 25,000, and you don't carry underinsured motorist, you've got a big gap there.
Got it.
So if you're going to have 100,000 on bodily injury on your auto, you might as well carry 100,000 to protect you or anybody in your car on the uninsured and underinsured side as well. Okay. And again, it goes to, if you increase it to 250,000 or 500,000, again, just if you're protecting other people for that amount, makes sense to protect yourself for that same amount, right? So that's one that we actually come into contact with a lot, is that you'll have a higher liability limit protecting other people, but you have a lower liability limit protecting you or everybody in your car, which it's not very, it's not very good, I don't think. You want to protect yourself. So
now this is really good to go over, because I think so many people will focus on, as you mentioned before, what's the cost of the car damage and what's my deductible. And it's not that those things are unimportant.
Right.
It's just you're missing a gigantic piece, really the bigger piece, potentially, of what happens if somebody gets seriously injured or dies. That's where the big dollars are. The car kind of is what it is. It's not that it's not meaningful, but
it's replaceable.
It's the big piece. We know what the car's going to cost to replace, what your deductible is. It'll be painful, but nothing compared to a liability claim.
Exactly. And on the deductible side, I'll touch on that a little bit. If you look at your driving history and you haven't had an accident in 10, 15, 20 years, it's safe to say that you can bet on yourself being a safe driver, right? So on that side of things, increase your deductible a little bit. Don't go with the common 500 or even 1,000. Bring it up to 1,500 or even 2,000 or even 2,500. Yeah, it's a big deductible to pay, but how often are you going to pay it? You pay it once every 10, 15 years.
Right.
You're going to pocket the premium you're going to save, and it's going to pay for the deductible over that time period. Bet on yourself being a safe driver. Yeah.
And I'll even add to that the financial side of it, because we'll see a lot of people who, their retirement's in great shape. They might even have a couple $1 million in retirement, So they're fine. They're covered. We're not really worried from a financial perspective. And yet they got a $500 auto deductible. So,
Yeah.
like you
Yeah.
said, if you're not usually in an accident, you have no problems. You've got the money to cover deductible if something happens.
Yeah.
Let's bring your rates down overall and bump
Correct.
up that deductible. And then let's not be walking around driving around with a $500 deductible because you don't want to make an extra
Yeah.
$500 or $1,000 payment when otherwise financially you're just fine. I mean, it's different if you're not financially well off and
Correct.
the
Yes.
deductible would be a tough payment. But for
Yeah.
those
That's
who are in good shape, especially in retirement, it's like, hey, do you need this deductible if you don't have any driving problems?
yeah. You want to make sure you want to look at your rainy day funds, right? You want to make
Yeah,
sure that you have enough to pay for the deductible,
yeah,
but it kind of picture the deductible as that. It's like it's a rainy day type thing.
yes,
It
yeah,
doesn't happen very often, if ever, but
right,
if it does, okay, it's gonna be a bad day, but we're gonna be okay.
yeah, that's great. So let's
So
shift over to the house and talk about liability because a lot of people don't think about liability
yeah.
when they think of house. They think structure, roof,
Mm-hmm.
water damage, sewer backup, all those things. And those are
Yep.
all important. We can talk about those as well. But liability coverage on the house, like somebody slips and falls, something crazy happens. How do we make sure that we are covered for the big stuff? Now, obviously, on the house, if a roof blows off or there's an earthquake, that's big stuff too.
Correct. Yeah.
But people don't often think about the liability side. How do we make sure we're protected all the way around on a house?
Yeah. So like you just said it perfectly. So the roof rips off. There's earthquake. Those are big. That's a big claim.
Hmm.
But just as big of a claim is liability, and it's one that's not looked at enough, in my opinion. The average home liability policy carries anywhere between 100 and 300,000 in liability
Mm.
coverage.
Wow.
I do not believe that's nearly enough. The average home liability claim can range from $2,000 if you're lucky, but if it's really severe, it can go north of 500,000 real fast.
Sure.
Um, so you want to again, it's the same thing on the auto. You want to make sure you have enough liability coverage to protect your assets, your net worth, right?
Hmm.
Um, I mentioned it in the beginning. So if you have a $300,000 liability coverage on your home policy, bumping it up to 500,000 again is only going to cost you roughly, not rough numbers here.
Yeah,
Don't
yeah,
quote me on it, but
yeah.
$20 a year.
Right,
It might be 22 or it might be 25, whatever. But
right.
you're gaining 200 extra thousand for exchange of $10 to $20.
Hmm.
That's just a no brainer, in my opinion.
Right,
And even going to a million, it can't hurt, right?
right.
And again, I said it before, even though you have that coverage, that doesn't mean that's where that limit stops. So
Hmm.
you just want to make sure you have a nice big buffer there. So if there is an incident, the target is not on you; it's on
Right.
the home policy.
Yeah,
That's what you want. That's the exchange of risk you're paying for, right?
yeah, yeah. And in terms
Um,
of target, I think what I've heard some people say before is, well, I don't want to have too big of a policy because then it puts a target on me if somebody can see that I have this insurance coverage. Like to your point, they're going to go for that anyway.
they're
They
going to go
don't
for
care
it
where it's coming
regardless.
from. Yeah,
They're either you're going to have the target on you, or the
yeah,
insurance policy is going to have the target on it.
right.
Now, me, I'd rather have the insurance policy have that target on it, right?
Yes,
That's like I just said. That's the exchange of risk you're paying for.
yeah.
So I think that one of the number one things to look at is just your liability coverage, and then obviously don't discount the fact that make sure your home's adequately covered, price per square foot.
Yeah.
These are all important things, but these are items that you can replace. If you have a kitchen fire, we can
Hmm.
rebuild it. House burns down, we can rebuild. Roof
Yeah.
gets tear off, we can rebuild. But your
Talk about that a little
liability is
more though,
key.
because go into that a little bit more because I don't think that's on people's radar either. We've seen home prices go up dramatically
Oh
the
yeah,
past several years. Do people need to look at that every single year, every other year to make sure that their coverage is keeping up with that? How does it go up automatically? How
hmm
should people be thinking about that as the
yeah,
past 5, 10 years, their home values have gone up, which is great.
yeah.
How do they make sure the insurance is still there to cover it?
Yeah, so your major carriers, Farmers, State Farm, American Family, the big names have inflationary and riders built into there. So you're going to
Okay.
have an influx already built in to try to keep up. and obviously your rates will stay put with that as well, right?
Yep.
These past 3 years, we've seen, I mean, we're close to 40 to 50% worth of inflation on
Yeah.
home policies itself, just because of cost of materials.
Hmm.
You look at the price of lumber 4 years ago, it was $250 a
Yep.
board, maybe.
Yep.
Now it's $7 to $8.
Hmm.
So that's a huge jump. Your home is going to keep on pace with that. The issue there is it keeps on pace with it on an annualized basis. So, for example, it renews in January, and we have 30% inflation of cost of materials between January and June. Your
Mm-hmm.
policy won't adjust for that until the next January.
Gotcha.
So after June, you might just want to reevaluate, make sure it kept up with the inflation,
Mm-hmm.
but it will increase a little bit more at that renewal in January.
Got it.
So just making, an easy way to make sure your price per square foot, I'm sure people know this, but just divide your total dwelling coverage by your square footage. That's
Mm-hmm.
your price per square foot. And that's the estimated cost to rebuild, not market value. Those are totally
Gotcha.
separate.
Gotcha.
Yeah.
Oh, good to know. Awesome.
Yep.
So you were talking about liability coverage earlier on the house. So I guess there's a difference between the liability coverage in the home policy, and then also one that you can get separately, correct?
Correct. So the separate one is the umbrella policy or
Mm-hmm.
extended liability. It can have a couple different names, but
Right.
basically how that works is it sits over your home policy and your auto policy. So you
Okay.
have $250,000 in liability on your auto, you have $500,000 in your home, and then you have an additional umbrella coverage which go in increments of $1 million,
Mm-hmm.
and that sits over both. So technically, your auto would be insured for $1.25 million, and your
Nice.
home would be insured for $1.5 million. So, for example that we go through with our clients is if your net worth exceeds the maximum liability available on your auto or your
Mm-hmm.
home, then we definitely need to tap into an umbrella there.
Got it.
So
So there's limits on those initial policies and what you can get.
correct.
Then
Yes.
you add on the umbrella on top of that.
Yep, exactly. And I'll say this too: it's just as bad to kind of be overinsured as it is underinsured, because then you could be paying for premiums that you don't necessarily need.
Sure.
So going through a fact finder and knowing exactly your net worth is very beneficial when it comes to reviewing these liability coverages. That
Mm-hmm.
way you can really dial it in. Just my professional advice here, because you don't want to have a $3 million umbrella policy when you're only worth 500,000.
Right.
Yeah, it's good. You're covered, but you're also paying away some money here.
Yes, absolutely. So in terms of the difference between having it be on the home and auto policy versus separate, is there a requirement to have so much on the home and auto before you can get umbrella? Is that how that structure is?
Yeah, you're exactly right. And every carrier is a little bit different
Sure.
on their limits. But the most common limits you would come across is that they would require you to have at least 250,000 on your auto and
Mm-hmm.
at least $300,000 on your home.
Okay.
But on the other side of that, if you increase your auto to 500,000 and you increase your home to 500,000, it actually lowers your umbrella premium to be
Wow.
about roughly the same price. I mean, you might
Nice.
offset a little dollars there, but you're gaining, $250,000 in coverage for the exact same premium.
Good. That's great. Good. Now, all very important stuff, just so people understand what this liability coverage is, because I think whether it's home or auto, they just focus on structure and not on, hey, what if for injury? And it can be random stuff. It could be somebody fell on your property when it was snowing or icing.
Yep.
Not
Dog
anything
bite
under
is a
control.
very common one too.
Dog bites, yeah.
Yep.
Yeah.
One thing I will mention on the home side, an endorsement that I would highly recommend everybody have on that ties into the liability, is personal injury liability. So this
Okay.
is separate from physical injury, or like if your home liability covers is going to, if someone falls on your property.
Okay.
But personal injury is for slander, defamation, discrimination, wrongful eviction, stuff like that. And that is a separate endorsement that you want to make sure you have.
Got it.
And again, this endorsement is not very expensive. You're talking $5, $10, $15 a year, maybe.
Oh, wow.
But
Okay.
it will cover a lot more.
Yeah.
And I definitely recommend at least having that.
Yeah. I guess part of the reason it's not so expensive, it doesn't happen too often.
Yeah,
The
correct.
insurance company just wants to make sure that in case it does, they
Yep.
have a broad coverage for a lot of people in that rare instance that it happens.
Yep, exactly. Yeah, the most common claim for home or insurance carriers is obviously physical loss, right? With
Right.
wind, hail, car accidents, and
Yes.
the physical car. But it's
Yep.
that severe enough injury that really could blow up that claim, right?
Yes. Awesome. Man, this is
So,
so important to just be thinking about this. So I really appreciate you being on here. What else should we be thinking about in terms of, I know this time of year we get into a lot of weather damage.
mhm.
Thankfully, we haven't had earthquakes in our area too
Yes.
much. I mean, if you're in California, different story. Is
Yeah.
there anything else people should be thinking of in terms of whether it's keeping their house up to date or reviewing their coverage every so often, things that you like to see clients do?
Yeah, there's a few things. So I'll start with this. Anybody that we bring on as a new client and review policies with, one thing I just recommend everybody do is just take a short 10-15 minute video of you
Mm-hmm.
walking through your house.
Mm-hmm.
It doesn't have to be super in detail, but just go
Yep.
through every room, look at some stuff and save that, because if, heaven forbid, there is a fire or a major catastrophe,
Mm-hmm.
you're going to be so emotionally distraught that you're not going to be remember every single photo or piece of furniture you have.
Yep.
That video would help you and the adjuster sit down and go through everything, make sure they have an accurate list of everything to get replaced.
Mm-hmm.
That's a big one that will go a long, long way, because
Nice.
you want to make sure you get everything replaced that you have, right?
Yeah.
Or at
Like
least
you said,
close to it.
it doesn't have to be you narrating every single thing you have. It's just
No,
scan the room
just
slowly,
real
walk to the
quick.
next room, and do the
Yes.
same thing all in one video. And
Yep.
yeah,
That's one I would recommend. You touched on earthquake there a little bit.
yes.
So one thing that I don't, people may or may not know this, but we have the New Madrid Fault in the south part of the state of
At
Missouri,
least where
right?
we are, right?
At least where we are, right?
Yeah.
Exactly. And that is the largest fault line in the United States, and that has not quaked in over 200 years. The
Mm-hmm.
last time it did, it made the Mississippi flow backwards and rang church bells in Boston. So there's that.
Yeah.
I my opinion on earthquake is you're protecting your home from all these sort of perils, right? Fire, wind,
Mm-hmm.
water backup. Um, there's two major exclusions on home policies that you can buy back, right? And one of them on the home policy is earthquake. The other is a separate policy, which is, excuse me, flood.
Hmm.
So if you're protecting all your home from all these different perils, to pay an extra 100, 200, relatively speaking, to buy back earthquake on your home,
Mm-hmm.
with how close we are to this fault line, and well, us here in Missouri,
Yes.
it might just be worth it, you know. But I would say our clients are 50-50 on it, because
Mm-hmm.
some say, no, it won't happen. It hasn't happened in 200 years.
Yeah.
Others say it might happen tomorrow, right?
Right.
My opinion is, like I said, I'm paying for this premium to exchange this risk. It's worth it for me to pay that extra $100, $200, $300 a year just to have that extra
Mm-hmm.
endorsement back on there.
Sure.
So that's one of them. And I would say the last one, let's see, would be just kind of touching like how we did on the auto policy with your deductibles.
Mm-hmm.
Look at it as a rainy day fund, right? Don't go out and buy a $500 or $1,000 or $1,500 deductible.
Yeah.
You can if you're comfortable with that, but by taking your bigger deductible, you're going to pocket some premium, right? So
Yeah.
look at that $2,500 deductible. Look at that $5,000 deductible.
Yeah.
Your biggest expense, or your biggest loss rather, will probably be, or your most common loss rather, will be your wind or your hail, right?
Yes.
So take that into account, depending on your location, obviously.
Yeah.
Take that into account, but picture that deductible as a rainy day fund. Like, all right,
Yeah.
we haven't had a home claim in 10, 15 years. The odds of it happening again are pretty low, but if it
Mm-hmm.
does, we can pay for it. It's a bad day, but we're moving on. But the premium you're gonna save, especially with the inflation we're seeing right now and the rates we're seeing right now, it's gonna pay for itself in a matter of 5-10 years.
Nice. Great. So can we wrap up by talking a little bit about water? I know that gets a lot of questions from people because, for example, some people might have hurricane coverage in the part of the world that they're in, but that doesn't maybe necessarily cover, I guess, a water surge coming in. That's something totally different. And obviously, where we at, there's flood coverage, but that's federal regulation. Then you also have sewer backup, which is water, but of a different variety. How do people think about what coverages are proper and what covers what?
Water is it's the lack of a better term, it's a nasty one. That line between a water backup, a storm surge, flood, hurricane is so thin, right?
Yeah.
One example I'll tell clients that kind of shocks them for a flood example would be water is outside water flowing on the ground through an outside opening. So, for example, if you had a fire hydrant out front of your house and it burst and it comes in through the front door, that water comes in through the front door or any side windows, that's considered flood. That's groundwater coming in through an outside opening. So that would be flood. One item that's excluded from all home policies that's not included on flood policies is seepage, water seepage. So where it seeps in through the cracks in the foundation. That's just not covered anywhere, unfortunately. That's just the way it is. And then like sewer backup, that's an endorsement you can add on your policy. Kind of look at your furnishings in your basement. If you have a basement, some people might have slabs, but those limits range anywhere between $5,000 and $50,000 worth of coverage. So if you have a finished basement, you're going to want the higher end of that, right? And then hurricane that's a whole totally separate one. They'll put a percentage deductible on that coverage, and that's anywhere between I believe they're 1 and 3, maybe up to 5% deductibles. And obviously that's along your coastline. But if you're along the coastline, you have hurricane coverage, and you more than likely should or have flood coverage as well.
Okay, good. So, thanks for taking the time to go through water. I know that can be very confusing. As you said, the lines between all these different things are very thin.
Yes.
Make sure you have coverage for each of them. That way you're not missing a piece.
Yeah, and you just want to make sure that it's maybe not something you need to go through every year with a fine-tooth comb, but every couple years, just to make sure everything's up to date, right? And you're happy with where things are. If you go out one year and you completely remodel your whole first floor, okay, well, you should definitely go talk with your advisor and make sure you up those coverages and make sure it's all adequate. But if you go out and buy new couches or new appliances, stuff like that, you still have coverage for all the new stuff. You might need to increase your personal property coverage a little bit, but those aren't astronomical numbers, right? Appliances nowadays, $1,000 to $5,000, depending on what you buy. Those aren't huge. But as far as like a remodeling, that's something you want to go through and making sure everything's adequate.
Nice. So if people are looking for insurance help, how do they find you? Where's the best way to locate you? Online?
Yeah.
Phone?
Yeah, you can. You can call us. Our office number is 636-498-4100. You can locate us online, Arnold Insurance Group. My email is tyarnold@arnoldinsurance.com. Just feel free to reach out. I can answer any questions or concerns. You want me to go through what you currently have and see if I can spot anything? I'm happy to do that. That's awesome. Give us a call or shoot us an email.
Hey, that sounds great. I very much appreciate you joining us on this episode. It was a ton of helpful information, and hopefully that gets everybody to really go through their policy. I guess first they probably have to find their policy. Go through their policy and say, what do I have? What should I be thinking about? And they're all welcome to reach out to you with questions and to review their policies. So thank you for joining us. That's been super helpful.
No, thank you, Dave. I appreciate it.
All right. Take care.
Have a good one.